More and more, financial markets are driven by things not necessarily based in reality. You don't have to have real money in your possession, rather just a good story about how you might get some money at some point. This is feasible because we've created a world where financial gains are privatized and financial losses are socialized, illustrated by the 2008 credit crisis, where banks could benefit privately from gains in the trading of assets such as mortgage-backed securities, and the losses from these trades and risk-taking were socialized in the form of huge bailouts from the public. Enter Greensill, a financial services company who primarily did supply chain finance and now revealed to have been built on debt. In hindsight, it seems unlikely that it would have passed a standard due diligence on its finances. Indeed, two of the big four auditors, KPMG and Deloitte, declined to be Greensill's auditors. Greensill has been around since 2011 and even had David Cameron, the former Prime Minister of the UK, using his private channels to lobby for them. We say was because Greensill filed for bankruptcy this March. The controversy is that in this seemingly boring and predictable market of supply chain finance, Greensill tried to make more money by using longer repayment terms and giving funds to companies against predicted versus actual sales. A quick exposition into what supply chain finance actually entails. Let's say you make widgets. You need money to buy the inputs, but your customer will only pay you after the widgets have been made. So you face a catch-22 situation. How do you make something that requires money to be made, but you only get that money after you've made the widgets? Supply chain finance provides the cash injection you need to break the cycle. You get a loan from these supply chain financiers who give you, say, 98% of the final value of the sale of the widgets. They then pay the full order value and pocket the 2 percentage points as profit. That amount is the cost of the loan to you. The industry doesn't seem controversial at first glance. However, Greensill was giving people finance for projects or goods that had not yet been made. In other words, they were giving out money for sales that had not been booked. Because these supply chain loans are treated differently in a company's accounts, you can hide massive debt obligations this way. These types of loans generally attract subprime lenders because of the higher interest payments. So now, Greensill was stuck with borrowers who might default. How should they unload these potentially toxic assets? Enter Credit Suisse, who then packaged up these loans and sold them on as investments to other agents. If you're getting déjà vu from the 2008 credit crisis and the story of mortgage-backed securities being packaged up and sold as low-risk products, you'd be right. This is spookily similar. Here is a quick timeline of the events as they happened, which shows how more and more financial institutions got entangled in this mess. Lex Greensill arrives in Britain from Australia in 2001 and works at Morgan Stanley, Citigroup, and then JP Morgan. He was also a senior advisor to David Cameron, the former British Prime Minister. In 2011, Greensill the company is formed, doing both supply chain financing and traditional banking as well. In 2018, the American private equity firm General Atlantic invests $250 million in Greensill. A year later, they get a large cash injection from SoftBank through its Vision Fund. Greensill doubles their headcount in a few years. By 2020, instead of giving out short-term credit for good companies, Greensill was issuing credit on future accounts receivable finance, which, as we've covered, are future sales that were not yet secured. Credit Suisse invests in these, and insanely, SoftBank, in turn, invests in the Credit Suisse product. The Financial Times reported on this so-called circular flow of funding. Also in 2020, the German financial regulator BaFin opens an investigation into Greensill Bank's accounting, not boding well for the company. We come to the present year, and BaFin files a criminal complaint against Greensill Bank and bans its activity. Finally, on March the 8th, 2021, Greensill files for insolvency protection as it found itself unable to repay a $140 million loan to Credit Suisse. It was also hit by defaults from GFG Alliance, one of its main customers, which is a whole separate story. So, what's the problem here? Nothing was outright fraud. This sounds like a relatively small problem affecting a few specific companies, and for the time being doesn't seem to have spilled over to a wider group of people. But we do see a few issues here. Firstly, this may be a growing industry where currently 80% of supply chain financing is carried out by big banks, but there are a growing number of entities like Greensill that are getting into the game. The pandemic has exacerbated this, leading to potentially more stories like this in the future. Secondly, the key is also the accounting angle. Supply chain finance is not treated as a debt, so it's difficult to know straight away what kind of shape a company is in when looking at their accounts. And finally, the packaging up and offering of this kind of debt as a mispriced investment is how the 2008 credit crisis began. And now what happens? No doubt, Lex Greensill will be fine and be heading up another business soon enough. Investors in Credit Suisse are now trying to recover their losses in a $10 billion supply chain finance fund. And as for SoftBank, they are still chugging along. We are Micro Insights. Thank you for watching this video.